Hermit and welcome to Breaking the Mould with Investment Director Russ Mould. Russ, how are you?
Very well, thank you. You're looking a bit less colourful this week, I know. It's very sort of, monochrome.
Yeah, I'm not dressed as a pumpkin this
No,
week.
not this time.
Russ, what is the fuss this week?
Okay, the fuss is all about the 3 R's. Royal Mail, retail and real estate.
Okay, should we get started with Royal Mail?
We should.
I want to know whether the fuss about the government perhaps selling it too cheaply has gone away yet?
Not quite yet. And I think it's fair to say we don't really know the answer to that question because the government still owns 30% of the shares. So we'll only find out whether we got a really good deal for us, you, when they sell that lot. And there's no timetable given for that yet. Will it be before the general election? Wouldn't want to be too dogmatic about that. And also, so we'll find out then what they get for that final slice. Then we'll know how much they brought in. And in the end, also the shares have come back from north of £6 to about sort of 4.58, 4.60. So some of the heat's coming out of that debate.
Okay, so that clears that up. Well, kind of, I think.
Yeah.
So what's so important about Royal Mail right now?
We've got numbers coming up on the 19th, interim figures, and boss Moya Green, well, she'll be looking to bounce back from what was a pretty tepid trading statement in July. And she said that letter volumes were good, which was a nice surprise. But the real surprise, the nasty surprise, was packages, parcels, which had been a strong part of the investment case at the time of the October 2013 float. So that really wasn't expected. That's put some pressure on the stock since. So we'll see what the figures have got to come up with there. But the issue really is competition. And intriguingly, the week after the figures, Green is actually speaking to a parliamentary select committee, along with some of her biggest rivals, Whistle, which used to be TNT Post, and UK Mail, and they're talking about competition in the parcels biz. Now, we know that Amazon's got this same-day delivery plan that they're doing with a small-cap company called Connect, so that competition isn't going away, and UK Mail actually dished out itself a pretty disappointing trading statement in September, and you can see what these competition worries have done to UK Mail and Royal Mail on the chart right behind us here. So, yeah, let's look at the numbers. On top of that, we've got a possible story with the French regulator, where the Royal Mail is facing some charges about anti-competitive practices. And also, in terms of the numbers themselves, the dividend's really the key. It's not a rapidly growing business, certainly at the top line. And so the yield is very key, big part of the investment case. For the full year, market's looking for 20.4 pence or a yield of around 4.5% at the current share price.
Right, so there's a whole lot going on there. But what's the scoop with retail?
Okay, retail, we're talking about Kingfisher, so let's dive into their third quarter number. You like that one, didn't you? Third quarter numbers on the 25th. Owns very famous brands, B&Q, Screwfix, one for all your home improvement buffs, one of the biggest retailers in this space in Europe. But the shares have, again, been quite weak recently. There's been a lot of worries over the European economies. Companies very big in France. I mean, UK and Ireland should be going well for it, but some of its continental businesses may be finding they're going an awful lot tougher. On the upside, the company's got stacks of cash, nearly £500 million net on the balance sheet, paid a 4.2p special dividend in July, and gives a good underpinning to the £6.5 billion market cap. But the real story is earnings momentum, or frankly, the lack thereof. And for the full year, this is the third quarter statement coming up, the market's looking for flat sales at 11.3 billion and earnings per share down 4% at just over 12p. Okay,
Royal Mail, check. Retail, check. That just leaves us with real estate.
A theme that we've referred to quite a lot here when we've been sat chatting away, and some of the sort of bullish news that we've been flagging, been coming through. Capital and Counties last week announced 11.7% rental growth in Covent Garden in just 3 months. There's been a bid for Songbird Estates, which owns Canary Wharf. So the sort of London commercial property market, still absolute Tabasco, hotter than Hades. And so we'll see what Shaftesbury got to say with their full year numbers on the 27th. They are the landlord for a lot of restaurants, cafes and shops in Carnaby Street, Chinatown, Soho, some pretty iconic places. So look at the NAV growth there, net asset value per share, the value of the underlying properties. That's expected to go up around 8% to 460p. Other issues to watch, vacancies, very low at 1.1% at the half-year stage in March. That should probably be driving rental growth for obvious reasons, and the company has hinted it may be looking for a few select acquisitions as well.
Okay, Russ, thank you very much. Thanks for joining us. This has been Breaking the Mould, and we'll see you very soon. Until then, goodbye and take care.